Hello, and welcome to MHA Larkin-Gowan's Insights, Brexit Bitseize edition. Today we'll be taking a look at farming, Brexit and beyond. If you're listening to these productions in chronological order, then this is our fourth insight. And while in podcast land it is not normal to date check, I feel it is important to highlight that this recording is being made in November 2020. And for all intents and purposes, a trade deal between the EU and the UK has not been agreed. Posturing suggests that we will be leaving with no deal, and with lockdown now imminent, can the government get a deal done? We will see. But this podcast assumes there is no deal in place. Oh yes, again for clarity. My name is Chris Scargill, and I'm a business advisor at MHA Larkin-Gowan, and we are putting together a series of podcasts on key issues for businesses as we reach the end of the period of transition and the date of 1 January 2021 looms large. We are looking to explore some of the issues and consequences of Brexit and what businesses need to do. We endeavour to avoid, where possible, any political bias or observation. Now, I did say we, so that means I'm not alone. And that makes it the perfect time to introduce today's guests. So I'd like to welcome the colleague, who will help me through the maze of assumption, presumption, and ultimate legislation. And that is my muddy boots guy, who always has his wellies firmly on the ground, Mr. Laurie Hill. Now, Laurie is a member of our agricultural team, and for all the right reasons is all over Brexit and what it is bringing to the agricultural sector. Welcome, Laurie.
Thanks, Chris. I thought I'd just give a little bit of background about me before we kick off.
Please do.
I grew up on a family farm in mid-Norfolk, and I'm still involved outside of the accountancy profession. And therefore, my passion and knowledge around agriculture is built on that foundation itself. This allows me now to specialise within agriculture at MHA Larkin-Gowan, and I am allowed to work with agri-based businesses and farmers across the whole eastern region.
Excellent. Thank you for that. Now, I do like a bit of a techie fact in each audio. So being my techie guest for the day, what fact do you have for me?
Well, I know you like your cheesy facts.
Ooh.
So did you know that cheese imports into the UK are largely Ireland, France and Germany? Ireland has a whopping 28% of these imports. However, it is strange to consider that Netherlands and Italy only account for 8% each. Two countries probably arguably seen as the home of cheese. In addition, to get you salivating a little bit more, Chris, between January and August this year, the UK has imported £260 million of cheese from Ireland alone. Cheese biscuits at the ready.
Absolutely, absolutely. Bring it on. So, Laurie, future of farming. Where do you want to start?
Well, for today's podcast, as you described, Chris, I thought we would focus more on the day-to-day farmer and less on the larger scale agri-based businesses, as my hope and assumption is that these larger scale agri-businesses will have started planning a while ago. Those day-to-day farmers and landowners that haven't started must start now, considering their own businesses and how prepared they might be for Brexit and the future pressures that come with leaving the EU. To answer your original question, Chris, I want to start with a fitness test.
A fitness test? This is a farming podcast, Laurie, not physical activity. I was thinking more wellies than training shoes.
I understand your confusion, Chris, but this is about the health and fitness of a farmer's or landed estate's business, whether that be as a sole trader, a family partnership, or a limited company, or even all three working together in sync. The health of an agricultural business now versus the health of an agricultural business in 5 years' time may be a completely different picture. BPS subsidies, or the basic payment scheme for those who don't enjoy an acronym, begins its tapering from 2021, next year, with its annual reduction through to 2027 when BPS will be no longer. And its replacement, ELMS, which is the Environmental Land Management Scheme, will hopefully be in full swing. We understand the extent of the first-year reductions of the BPS as published by DEFRA, but there is no hard evidence of the future reductions as yet. ELMS will promote the flora and fauna of the environment, public money for public good, as the Agri-Bill states, but we won't delve into the Agri-Bill, as I suggest we should discuss this in a future podcast, Chris.
Mm-hmm.
But whilst on the topic, I must note that the BPS value is a significant proportion of the farmer's bottom line income. It's almost a third in most cases, and therefore farmers must act now and begin to put a plan together.
A third of bottom line income will be a major loss to some farmers, Laurie. How do we as business advisors help our clients to prepare for this? Now, I know we recently published a 10-point plan, but that's a lot of numbers to go through. So can we focus on 3 key takeaways to get through to unscathed as possible today? What do you consider the most relevant?
Well, actually, I've amalgamated some of the points together as I consider this to be more relevant for our listeners. First point is the simplest for farmers to consider. However, it does involve a large chunk of number crunching, which for you and I, Chris, is our day-to-day job. But many farmers can be averse to a day in the office. Personally, I know my father is not one for an office desk.
I hope your father doesn't mind the attachment to that criteria.
No. I think he would certainly agree with me. It's not often I catch him in there. But in all seriousness, farmers and landowners must start setting 12-month budgets and aim to roll that into a 5 to 10-year budget based on crop rotations and an estimated price. But there is a big but in this, in all realistic sense. The budget must be without any form of BPS subsidy. There is no point in including the BPS monies as it defeats the purpose of the exercise.
At this point then, Laurie, what questions should farmers and landowners be asking themselves?
The first question, and most prevalent in my mind, is can the business survive without it? And secondly, is there still enough cash for the family to live on and for the business to operate to its best capacity? The next 7 years will be tough as the BPS payments reduce and farmers must begin to search for new ways to expand their businesses, whether that be through diversification or to try and trim costs down. It will be clear to farmers and landowners that a change is necessary. Any business in any industry must continually adapt to survive, and if that involves number crunching, then so be it.
So lowering costs, are you talking about variable costs, fixed costs, or indeed both?
Both, to be honest, Chris. There are fixed savings costs possible, which is a point I'll cover in a little while. However, from a variable cost perspective for seeds, ferts and sprays, there are certainly ways to be productive whilst lowering these costs. Interestingly, one solution is linked to a recently released software platform, where we are working in partnership for a webinar with a tech firm called Yagro, who recently launched an analytics program which is aimed to help farmers collate their data and present it in an easy and simple to use format. This is historical data, but it can be considered alongside forecasting because the underlying historical data does provide a pathway to more accurate future costings and identifying areas of possible cost savings. Businesses strive for different goals at the end of the day, and I've previously written about the statement, turnover is vanity, profit is sanity, but cash is king. I fully consider that cash is king in these scenarios. This is a mantra that many businesses live by. You may produce profit, but you need to keep producing cash to invest and live off. Part of maintaining cash levels and understanding the cash requirement in your business can be important to making key business and investment decisions. Therefore, by mentioning a 5 to 10 year or pulling together a 5 to 10 year rolling plan would enable a rounded view of what cash and profit levels might look like. And for farmers and landowners, they must remember to include their own drawings and salaries within these cash requirements.
I understand your point, Laurie, but do you think some farmers are more prepared and have better data available than others?
Yes, for sure, Chris. At the end of the day, it comes down to their own desire for detail. The age-old saying of "fail to prepare to fail" comes to mind. This may be a bleak viewpoint, but I cannot stress enough to farmers, including my own clients, that is, that you must be forward thinking in order to survive in what is coming in UK agriculture.
Absolutely, definitely. Okay, so what would you consider to be a key takeaway number 2?
Number 2, a business appraisal, or a SWOT analysis, or an asset assessment.
The old SWOT analysis takes me back, Laurie. That was the age-old business tool, I think. A simple tool such as a SWOT analysis can show what are some of the opportunities for farmers, I guess.
It's a simple technique that any business can employ to assess the strengths, weaknesses, opportunities, and threats to their business. But if necessary, farmers and landowners could get an external advisor in, whether this could be an agri-consultant or even an accountant to help out on a one-off fee. They can come in and help to appraise your business.
So what would they bring to the party?
Well, an external advisor may consider options that the farmer wouldn't think of him or herself, and also might unearth some home truths that the farmer and or landowner may not wish to admit to themselves in their own assessment of the business.
Mm-hmm.
Many farms have underutilised operational assets with either too many tractors or too many trailers. Could these assets be shared with the farmer next door, or even hired out during quiet periods on farm as a way to create an additional income stream? Others will have underutilised or derelict farm buildings or sheds. Plus, they might also have low productivity land that could be best suited for another purpose. There are many options with permitted development for farm buildings and sheds to be converted into housing or office space, pieces of land that could be considered as development land, or even parts of the farm that may be best suited for woodland. In the future, woodland areas especially could be expanding from the desire of the UK government to push agriculture into a greener space, and this could also see a growth of the market for carbon credits. But
good point.
It's one of those things that it will become increasingly popular, but and a key point of the reduction in carbon emissions. But personally, woodland and carbon credits aren't my area of strength and expertise, so we won't delve into that too much right now. But in all seriousness, threats facing farms are variable and will be different business to business. But one is clear: the loss of BPS as a result of Brexit. There obviously are other threats that I can mention, which you could say lack of succession, but obviously that's not a Brexit-related issue.
No, it's not. But that's really good stuff. That is, Laurie. Thank you very much. So, right, I think I'm keeping up with the counting, and that's now point number 2 covered. So, last but not least, what's the final takeaway for today for farmers and farms when preparing for the future post-Brexit? What is it? I'm waiting with bated breath.
Well, my third and final takeaway is for farmers to consider: could I work with my neighbour? Is there a possibility of creating a joint venture or share farming arrangement? If there is a possibility, how would it work? What are the implications, and could it actually work in the first instance? Is a question they must ask and answer. In recent years, joint ventures and share farming arrangements between neighbouring farmers have grown in popularity as they look to share the burden of key fixed costs such as labour, machinery repairs and maintenance, and depreciation. By sharing the fixed costs, it aids cash flow in each farmer's own business, whilst there are other gains to be had, such as reduced capital outlay on machinery and implements for each farmer, whilst obtaining the full benefit.
Mm-hmm.
It tackles the point of farming businesses only underutilised machinery that then creates unnecessary additional fixed costs, such as insurance costs, for example. The point we raised earlier in our SWOT analysis consideration. But with any new enterprise, taking timely advice is key and very important. Getting the legal structure and agreements right, as well as planning and the business rates point. It would also be remiss of me not to mention tax, Chris.
It would.
Especially as us as accountants. But in all seriousness, understanding how income is taxed and the impact on capital taxes as well as VAT will make sure your new venture gets off on the right foot. Furthermore, the structure of the deal must be considered as to what impact this could have on the next generation. We wouldn't want to disrupt any future inheritance, but within the current system, a trading entity would see 100% BPR.
Yeah, while that still exists.
Exactly.
And yeah, well done for getting the tax details in there, because again, all of this is important. So that's wonderful there, Laurie. So clearly a collaboration in farming may become more prevalent in years to come as a way of creating some efficiencies. But you are right that any new venture, joint or otherwise, must be set up correctly in order for it to undertake its intended purpose. Shareholder
Mm-hmm.
agreements, legal structures, they all have to be airtight, don't they?
Agreed.
So, well, thank you, Laurie, for taking me through your 3 key plus, I think it was today, points of consideration when aiming to get farmers prepared for the future. If I were to ask you for an executive summary recap of just, say, 1 sentence per item, could you do that for me?
Of course. So first point, get your numbers in order and start preparing. That is now. If you need assistance, contact your accountant for some help. Number 2, appraise your business and really truly be honest with yourself and honest about the business. If required, get external help. Point 3, collaboration may be key to your survival, but this isn't the solution for all farmers and landowners. Look at your business from point 1 and 2's perspective. Is point 3 worth considering, or could you make it on your own?
Excellent, Laurie. Fabulous. And added value there. I asked for 1 sentence per item and you gave me at least 2. So really good added value, but really good constructive advice. So thank you very much for your help today. And let's have another chat soon. But first, though, I'd like to thank the listener. So thank you, listener. You have been listening to the MHA Larkin Gowan Insights Brexit Edition podcast and have been listening to me, Chris Scargill, and him, Laurie Hill. And I'd like to remind you that details of what we've covered today are on our dedicated Brexit hub on our website at larking-gowan.co.uk. Right, Laurie, what's happening on the farm right now? The autumn's been rather wet, hasn't it? So must they get onto the fields rather?